I believe you should be able to see my screen now. Sorry, you need to copy this link. So yeah, welcome to the class tonight. And tonight we'll be looking at IAS 38, Intangible Assets. So this standard explains to us the clear understanding on IAS 38, Intangible Assets, and also the recognition criteria and the expected information to be disclosed in our financial statement. So we are going to start with the definition of a tangible asset. Tangible asset is an identifiable non-monetary asset without a physical substance. So tangible assets are those kind of assets that it's an identifiable non-monetary asset without a physical substance. That is, it will be something that we can't see with our eyes, not to talk of having a physical substance that we can touch and identify directly. But however, it exists and it's something that we can actually determine their value. So intangible assets are identifiable non-monetary assets. So IAS 38 prescribes the accounting treatment for intangible assets as well as relevant disclosure in respect of the intangible asset in financial statements. So IAS 38 applies to all intangible assets with the exceptions of those covered by other standards. So what they are trying to tell us, we have not discussed IAS 16. Probably that will be our next topic after this. Okay, we are going to look at IAS 37. Then after IAS 37, we are going to look at IAS 16 and IAS 40. So IAS 16 is tangible. These are the tangible assets that is being held for administrative purpose in the organization. That is one way we are going to be. But what we want us to understand here is that this standard covers all forms of intangible assets except those that have been taken care of or that has been covered by other standards. Just like we know that the standard work interrelatedly. We are talking about IAS 16. You can link it to IAS 2, you link it to IAS 40, you link it to IAS 41, and at the same time we link it to this IAS 38. So basically what we'll be discussing under this here under this standard is going to be mainly on those intangible assets that is not being covered by any form of other accounting standard. So let's look at some key definitions. So we have the intangible asset. This is an identifiable non-monetary asset without a physical substance. That's let me enlarge it because over time people have complaining online. I believe it should be feasible enough now. So these are identifiable non-monetary assets without a physical substance. That is, they are identifiable assets that cannot be seen or touched, but have economic benefit that will flow into the entity. So what are you trying to let us understand regarding the meaning of IAS 38? That they are the kind of asset that there is no physical substance. You can't see them, you can't touch them. But however, they have a value that they contribute positively to the organization value in general, to the company value in general. So identifiable non-monetary asset without a physical substance simply means that there is no physical substance. We don't have any physical treasure that we can point to that this is what we are talking about. But however, for them not to have a physical substance that we can talk about does not mean that they cannot contribute a substantial value or a substantial influence. They can also have a substantial influence on the value of the company, maybe in the case of merger and acquisition, So they are not physical substance assets, but they have a very economic benefit that flow into the organization as time goes on. So we have research. This is the original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. So as time goes on, we get to understand the reason why we need to understand the definition of research. We also have the developer. This is the application of research findings or other knowledge. So it's a step after research, for any research that we see that, okay, this is going to be a worthwhile finding for us, then we move from that research phase to a development phase. Development phase is where we put more effort to what we have researched on in our first stage, in our initial stage. We put more effort on it to develop what we research on. We put more investment on it. We put more, energy just to make sure that we arrive at a meaningful and findings. So after that, we have amortization. It's the systematic allocation of depreciable amount of an intangible asset over its useful life. Just like we have depreciation for intangible assets, we make use of amortization. The process of spreading the value of that asset over its useful life. So we have non-monetary assets. So first of all, look at monetary assets. Monetary assets are use of currency or other assets that represent right to receive a fixed amount or determinable amount of cash. That is mean determinable amount of cash. That is determinable number of units of currency. Examples are trade receivables, bank balance, no receivable. So what we're trying to understand, try to let us understand is that when we talk about monetary assets, these are substances that represent, the right of the organization to receive an inflow in terms of a unit of currency. An example of them, we have the trade receivables. So what we are trying to let you understand here is that intangible asset is different from all the examples we have here. So because we say they don't have physical substances, someone will be thinking like, okay, trade receivable is just a figure we have. Yeah, it's really a figure we have, but however, it's totally different from what we are trying to let us understand here. In the time of when we talk about the trade receivable or bank balance or loan receivable, there are units of there are determinable number of units. It speaks to a particular previous event that has occurred, which give the organization or the owner of that value the right to receive the value that it's being carried as maybe receivable or balance or loan receivables. So we have non-monetary assets. These are assets that do not represent a right to receive a fixed amount or determinable amount of cash. That is determinable number of units of currency. Example are inventories, property, plant and equipment, equity investment or share investment. So we are just trying to let us know the difference between monetary assets and non-monetary assets And from the definition here, we can see that the clear difference between them is that for monetary asset, there is a unit of currency that is being attached to it, and it as a result of past events that give the right to the receiver of that particular value. So example of intangible assets, we have purchased goodwill. So goodwill in the general term, you will understand that it's not something that have physical substance. But however, it is the difference between the purchase consideration that maybe a parent company pay to take over its subsidiary or its associate. The difference between that purchase consideration and the worth of that company. Let's say, for instance, if a company worth 50,000 naira, but at the end of the day, the parent company is paying 55,000 naira to acquire a company that is being valued at 50,000, both in terms of assets and liability. So the difference between that purchase consideration that is being paid to acquire the asset, the difference between the purchase consideration and the value of the company is what we know as goodwill. So it's what we know as purchase goodwill. We also have computer software. We also have the copyright, the patent right, franchise, license, development costs, where certain criteria are met. We are going to look at the criteria later tonight. So we have copyright as well. So example of items that are not intangible assets, we have internally generated goodwill, internally generated brand name, research costs, preliminary or pre-corporation expense, expertise of employee, marketing and advertising expense, customer list. So one of the main reasons why that differentiate those examples we have here and those one we have as intangible assets is that for most of the examples we have here, there is no how we can be able to have the actual value for it. In terms of if we take it to consideration under IFRS 13, all of the criteria that must be met before you can say, okay, this is the actual fair value of a particular asset, is that there must be a clear valuation process. If you are talking about internal generated goodwill, when you generate an internal goodwill, there is no how the company will be able to value that internally generated goodwill by themselves, unless the situation whereby there is a need for merger and acquisition, whereby an outsider is coming to take over. That is when they will be able to value. But for the company to have, sit down themselves and say, okay, this is the value of our goodwill, it's not possible. It's not realistically possible. So internally generated brand name. So you can't know the worth of it's like saying the organization is trying to value the efficiency and effectiveness of their operation. They are trying to put a value to it. Although that can tell in terms of the general term of the organization, general performance of the organization, but not like the organization sitting down by themselves saying that, okay, yeah, we want to value this brand name by ourselves and add it to our financial statement. It's not going to be done like that. It's not possible. If that is done, then every organization can just wake up one day and say, now our brand name is 50 million, so we need to include it in our assets. But however, if it's a purchase goodwill, maybe there is a merger or an acquisition that takes place, for the company that is taking over another company, it will be very easy for them to know that, okay, this is the amount that we can say that, okay, this is the value of the goodwill that we purchase. But they have known the worth of the company. They compare with what they pay as purchase consideration. The difference between these two figures will likely give them either a positive goodwill or a negative goodwill. That should be what you will be discussing under your group account. So for a positive goodwill, that is where you have purchase goodwill. So recognition criteria, before you can say, okay, this is an intangible asset of a particular company, there are some criteria that must be met. One of the criteria is an entity must have control over the assets. An entity must have control over the assets. Another one is it must be identifiable. It must be identifiable. Number 3, it must be probable that future economic benefits will flow into the entity as a result of past events. So, and lastly, we have the cost of asset must be reliably measured. If you look at all these criteria and you try to put it to an internally generated goodwill, you will understand that an entity, yes, an entity will have control over it. The asset must be identifiable. How do you want to identify an internally generated goodwill by yourself? You can't do that by yourself. However, a third party that is taking over your company can actually pay for that. So yeah, it must be probable that future economic benefit will flow into the entity. The cost of the asset must be reliably measured. So those are the recognition criteria that must be met before an organization can call a particular asset an intangible asset. So we have initial measurement and subsequent measurement for intangible asset. Initial measurement, at initial stage, intangible assets acquired in a business combination, that is purchase goodwill, should be initially measured at fair value. This should be what we could have discussed in your group account. Sorry, I don't know if I have a message. Sorry, let me quickly check. So there is no message. So once we through with this explanation, I'm going to open the floor for questions. Okay, there's no message. Just continue. So, intangible assets acquired separately, e.g., software. This should be initially measured at cost of acquisition. Intangible assets acquired in form of government grants. This should be initially measured at fair value or nominal value as prescribed by IAS 20. So IAS 20 talk about the government grant. We're still going to look at that if time permits before the diet end. So intangible asset developed internally, development cost. This should be initially measured at cost. We are going to look at the necessary criteria that must be met before a development cost can be capitalized as an intangible asset. So intangible assets acquired by way of exchange of asset, this should be initially measured at fair value of the asset received or asset give up if fair value cannot be reliably measured. Please let's take note of this initial measurement. These are different categories that may give rise to intangible assets. We can have it in form of government grants. We are going to use the government grant measurement to determine the value. We can have it in form of software being acquired and an acquisition, a direct acquisition directly. So during that, we are going to make use of the cost paid to acquire that particular intangible asset to determine the value, the initial measurement of the intangible asset. We also have the business combination, that is purchase goodwill, which is our working note. Is it working note three or working note 4? We are preparing our group account working note. So the subsequent measurements, all intangible assets should be measured using either cost model or evaluation model. So if we are using cost model, the cost of the intangible asset will be the initial cost less accumulated amortization and less accumulated impairment loss that may have occurred over the period of time that the intangible asset is being put to use. The revaluation model, sorry, this is the revalue amount of the tangible asset less subsequent accumulated amortization, less subsequent accumulated impairment loss. So there would have been a revaluation process that is being carried out in line with the required standard for us to determine the value amount. So we can also have either upward evaluation or downward evaluation. So note IAS 38, according to IAS 38, entity should not use evaluation model except there is an active market for the intangible asset. That is, before you can tell us that you are using evaluation model, there must be an active market that shows that that value you want to tell us that this is the valued amount was being done at arm's length, was being done by a knowledgeable market participants, not just that the entity just decided to do that by their own, just to inflate the value of the asset. But if it's an asset that have an active market where we can easily see those values that will give us an accurate value of the asset, then the entity that can consider to make use of the evaluation model. So the amortization, like to commence amortization valuation deficits, valuation surplus, impairment. All these are exactly the same thing as we have in IAS 16. So I think this could have made sense for us to have taken IAS 16 before this course, but no problem. Our next topic is going to be IAS 16, and we are going to discuss all these key points on that. But the amortization process is just a process of spreading over the value of the asset, just like we have IAS, just like we have depreciation under IAS 16. Also, when to commence amortization, once the intangible asset is available and it is being put to use, definitely you can amortize, you can spread over the value of the asset over its useful life. When to cease amortization, that will definitely be when we recognize the assets. Sorry, please, 1 minute. So, just like I've said, when to cease amortization is when we recognize the intangible assets, or we reclassify it to another classes of assets, maybe IFRS 5. Then when we do that, just like we have it, that if it's an IAS 16 type of asset, so we are going to stop depreciation. The same thing is applicable to an intangible asset. We are going to stop the amortization. So that is if what we have is a classification of classes of assets, or when we de-recognize it, we are going to stop amortization as well. However, for those assets with infinite useful life, we are not going to amortize their value. But however, what we are going to do is that we are going to be testing them for impairment from time to time to see if there is an impair in their value or there is not. So the valuation surplus, that is when we value the asset and we have a surplus in time of the value, which we are going to recognize in our other comprehensive income. At the same thing, revaluation deficit, we are going to take it to our other comprehensive income. We are going to look at all this deeply where we are looking at IAS 16. So important notes on amortization and impairment of intangible assets. An intangible asset with an indefinite useful life, this should be amortized. This should not be amortized, but should be tested for impairment on annual basis, at least annually. And an intangible asset with a finished useful life should be amortized over the useful life and should be tested for impairment if there are indicators or triggers, that is, if there are signs of impairment. So that particular asset, intangible asset, should be tested for impairment. We now have research and development costs. So research costs, these are costs incurred by an entity at a preliminary or research stage of obtaining a new knowledge. So for an entity that want to, when I was discussing that at the beginning, I said that we can only recognize an intangible asset that we purchase, not internally generated one. However, for internally generated intangible assets, there are two stages to it. If we have it under the research stages, that is the preliminary stages, the first phase or the first stage, the inception stage, when the company is still trying to incur some expenses to be able to see, okay, is this worthwhile? Is this something we can work on? Is this something we can develop in the long run? So all these costs incurred under the research phase cannot be capitalized. You are going to expense it, which means you cannot recognize an intangible asset that is under research phase. However, according to IAS 38, okay, all research costs should be recognized as an expense in profit or loss in the period incurred, irrespective of the amount involved. But when the cost now reach a development stage, when you have incurred the cost, it has passed through the research phase. You have now seen that, okay, this idea, it's something we can develop internally. Maybe it's a software you are going to work on, or it's any form of intangible asset that it could be. You have now seen that, okay, this is something we can actually develop. This is something we can actually work on. You have now moved it from the research phase to the development phase. Now, when the intangible asset is under the development phase, there are 6 criteria that must be met before we can now capitalize the cost we incur up to that development phase. If all these criteria are not being met, we cannot go ahead and capitalize the cost incur even at the development phase as an intangible asset. What are the criteria? IAS strategies require that development cost to be capitalized and recognized in financial statement as an intangible asset if and only if the following criteria are met. Number 1, it must be probable that future economic benefits will flow in to the entity. Before you can capitalize a cost at the development phase, it must be probable that future economic benefits will flow in as a result of past events. It must be probable that future economic benefit will flow into the entity. Number 2 is the intention. The entity must have intention to complete that findings, to complete the development of that particular asset before you can now say that, okay, as at this development phase, we are going to recognize our cost as an intangible asset. The entity must have the intention to develop the asset, either to use or to sell. You must have the intention to complete it. That is the first thing. You must have the intention of completing it. So when you now complete it, you may now decide that, okay, something we continue to put into use, or it's something we are going to sell off, depending on the decision of the management. So number 3 is all the resources necessary for the completion must be readily available. That is, the process to complete this development must not be in doubt. It must be clear that the entity are ready to walk through all the process that is being required to complete the development of the assets to the end. Not that the entity now say that, okay, along the line we decided to stop. If you are going to decide to stop, that means that development cost has not met up the recognition criteria to capitalize the amount spent up to that stage as an intangible asset. Number 5 is the ability to complete. Resources must be available is number 3. Number 5 is technically feasible. It must be technically feasible that it's something the company have the capacity to complete. It must be technically feasible that the company can actually complete it. You can't embark on a project that is so clear, like it is technically impossible for you to complete it, and you say you want to recognize it. It must be something technically feasible that you have the capacity and you are going to complete it in a real sense. And the last one is the expenditure incurred on the development stage of the intangible assets can be reliably measured. The cost must be reliably measured. So you can use the acronyms PIRATE, 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 to represent the recognition criteria that must be made before a development cost can be capitalized. So, website cost. Standard Interpretation Committee require that website costs should be capitalized and recognized as an intangible asset in the financial statement if and only if the website is capable of generating income. Therefore, any other website cost other than this should be recognized as a profit or loss. So, website costs for those companies that their website is capable of generating revenue for them. As people visit that website, it's going to generate revenue for the company. Example, Facebook. For everyone that visits Facebook, there's no how they will not have their own influence in terms of the data you spent on the site. All the social media networks. So I believe those are the major sites that meet up this criteria. But for a normal company that their website is not a revenue generating site, it's just for their customer or potential customer to have more clarity about what the organization are into. You can't call your own website cost an intangible asset. We are going to recognize it as an expense under the profit or loss statement. But for organizations that the website alone, it's a revenue generating site. You get, for all these streaming platforms, that once you visit their website, you are not just there to know about them, you are there to actually engage in an activities that will bring a substantial inflow for them. So these are the recognition criteria that must be met before a website post can actually be called an intangible asset. I doubt if you can still look at IAS 37 tonight. I doubt it. I doubt it. I doubt it. Well, I believe it's something we can still look at, just that the explanation is almost 10. It's almost 10. So I basically, let me just brush us through it. So IAS 37 talk about three things: provision, contingent assets, and contingent liability. Provision, contingent assets, and contingent liability. So a liability is a present obligation of the entity to transfer economic resource as a result of past events. So these three key points have their own different criteria, have their own different how should I put it, have their own different key points that must be present before we can know that, oh, this is a contingent liability. Oh, this is a provision. Let's look at this first paragraph. We have timing, we have amount. So these are the two headings. We are certain about the timing, we are certain about the amount. If these two things are certain, the timing and the amount, then what we are going to do, what we have there is what we have a liability. And the type of liability we have there is we have the like of accrual, trade payables, bank loan, bank overdraft. These are the categories of liability that have these two qualities. For a trade payable, you know the time you are expected to pay back your supplier, and you know the amount. Bank overdraft, you know the time, you know the amount. Bank loan, you know the time, you know the amount. However, another example is when the time is uncertain and the amount is uncertain. That means there are still some scenarios that must happen before we can call it a liability. Then that is a contingent liability. That is the contingent liability. Don't let us rush this standard tonight. Don't let us rush it tonight. Or let me allow you to decide. If you still want us to discuss it, we can actually discuss it. Let me allow you to unmute yourself. Yes, I will drop the notes. I'll drop the notes. So, Mr. Oluwatobi Loba, please, you can go.
Good evening, sir.
Good evening.
Thank you for your time. So I have two questions. The first question is, I would like to say that we should continue with this intangible asset, or is that all about it? I don't think we should rush into IAS 37 today. I don't mind if you continue IAS 38, and maybe probably if there are questions that we want to solve on them, we can do that. Then the second one is, you mentioned something about when you were discussing about website costs, that IAS 38 states that it must be disclosed if the entity is generating economic benefit from it. Now, for an entity that is for an entity that is a first year entity, are they meant to continue disclosing it every year in the financial statement, or just that one first year financial statement? I don't know if my question is clear.
So, are you talking about the cost incurred on
Yeah,
that website?
yes, yes.
So,
In the in the terms of Facebook now, just
right.
as you have used Facebook as a context, let's assume that the entity use Facebook to generate economic benefits Is it every year that they will continue disclosing the financial statement, or just that year?
Okay, so just like to say that for an intangible asset that have a specific useful life, you can use amortization to spread the value of that asset over its expected useful life. However, for an intangible asset that their useful life is infinite, there's no specific useful life to them. So what we are going to do to that is that on yearly basis, the company will continue to test for impairment in terms of the value of the asset if there are some key indications of impairment. So what they will be doing yearly is to test for impairment. But irrespective of either number one or number two, the company will continue to carry that particular asset, that particular value of the website as an intangible asset in their financial statement. Note, for a revenue generating site, it's different from normal company website. For normal company website that their website is not used for revenue generation, what they will do is that they will expense the cost incurred in building that cost. For the period that they incur, they will expense the cost in their profit or loss statement. But for a company that their own site is being used for their revenue generation, like I said, Facebook, I don't know if that, I believe, to me, Facebook meets up the criteria of saying that, okay, our site is used for revenue generation. There's no how you will visit Facebook that they will not generate revenue in terms of the data that you spent on it. All these social media, TikTok, Twitter, Instagram, there's no how you visit their site just to know more about them. You're not going there to know more about them. You are going there to engage. You get. So for company like this, their site is being used for revenue generation. They will continue to carry the value of that site in their statement of financial position. So if it's an intangible asset that have a specific useful life, maybe due to a particular license that they are using for that particular website, maybe the person give them the license for 10 years. So they will amortize the value over 10 years. So when they renew it, they'll bring it on again like a new asset. But if it's all this type of asset that have an infinite useful life, which I believe a key example of that is goodwill. To me, goodwill does not have a specific. So far, there is a ability of going concern in the organization. They can continue to have that goodwill. Dangote is there over years. We have Boa Cement. Companies like that, their goodwill, I believe their purchase goodwill should be a goodwill with indefinite useful life. I don't know if I answered your question, man.
Yes, sir. Thank you, sir.
Do you have any other question?
No, I'm fine.
All right. So I think I'm only the class 2 notes. Our IAS 10. Let me share that right now so that I won't forget. IAS 10, and now we have so I will share it to the remaining class too. Once I've shared it, I will share the rest to the remaining class too. So I will share the rest too. I will share the rest with this second note. So in case we have a free period during the week, we are going to look at it. We are going to make use of it to look at IAS 37. So by next Monday, by God's grace, we are going to start IAS 16. After that, we look at IAS 40. We look at IAS 36, and our exam is fast approaching, so that we can start preparing. And also, I will urge every one of us for our group accounts, our cash flows, our ratio analysis. Those are the key topics that always they will be there. It's now left to ICAR to decide maybe they will come as a first compulsory question or a 20-mark question. Either ways, even if our lecturers are not available sometimes, they also have a lot of engagement they are into. So we should make use of those periods to check the YouTube page and see the previous lectures, like group accounts. We go through the APES group, APES page, YouTube page, check the group account treat the last diet. Group account is this the same thing over years. The only difference is that there will be the new inclusion of standard, this and that, but the process, the working notes, the requirement, the structure is still the same thing. So just make sure you get yourself acquainted to all those previous lectures when the lecturers are not available, so that that particular time will not be wasted. You get the same thing with your cash flow too. Those are very key topics that there's no how you can escape both of them at a time. If one did not come, the second one will come. As a matter of fact, both will definitely come. It's now left, okay, maybe one will be number one question and the second will be a 20-mark question. Group accounts, cash flow, ratio analysis, they are very key topics that you need to take your time to go through it. Please don't let us waste our time. The time is fast approaching. So once we don't have our lecturers available, we should try to make use of that 1 hour, 2 hours by ourselves by visiting the previous lecture on the Apex page. We also have some of these particular page we are using presently, so you can go through it as well from this page. Check through the group account lectures that they have done in the past. You get for you to have a well-equipped information ahead of time. And if you notice any differences in what your lecturer is taking you and what you saw online, you ask question. You ask the lecturer, okay, this is what I noticed. Is this the same thing or is it done differently? So that we can get more clarity regarding each topic. So, do you have any question again, please? In case of no question, don't let us waste much of our time. So it's likely we are going to meet again during the week if we have a free lecture and if I'm available to. So I'm going to use that moment to run us through IAS 37 so that we won't bombard ourselves tonight with the 2 standard. Although the standard looks simple and very short, but however, we need to have a clarity around it. We need to read more questions. We need to, check the past question, see what year is being tested, see how the question look like. Look at your notes. Do you have answer that speak to this, or did I need to ask more questions? And should the case you come across anything you need more clarity on, can reach out to me on my WhatsApp line as well. So we are going to look at it together. So someone reached out to me long time ago on IAS 23 regarding the operation we did. So I don't know if the person is online.
Yes,
So
I'm online.
Okay. Good evening. So you asked me a reason why we did that operation, right?
Yes.
So let me quickly see if I have the question here. I'm very sorry. I've been looking for your number to reply, but when you asked me that time, I'm not okay around that time. That we just need to let me check. I think this is it. Yes, this is it. So which question are you asking? Question what?
The first calculation, the figure to be capitalized.
The what?
The first figure, the first drawing.
Okay, is it on this question?
Yes.
On this particular question, right?
Yes.
Okay, so what is your question here?
My question is that when I did the calculation, it did not correspond with this one. And in the punch finder, I noticed that the surplus investment, they use 160,000.
In the surplus investment?
Yes.
Surplus investment. Okay, let's read the question first so that we will just be solving. Sorry, hope I'm not taking much of our time. I just want us to. I've had the intention that I'm going to bring on this question so that we're going to look at it together. So, what is the title of that question? Is it factor mass?
Yes, factor mass.
Okay, this is it here.
Yes.
I hope you can all see my screen. Yeah?
Yes, I can see your screen.
Okay. So the question is this. So the A part asks us to state the condition where borrowing costs can be capitalized, and where it should not be suspended, where we can suspend it. So now the second question where we have the calculation. Itemize constructing a factory that will take about 18 months. That'll take about 18 months to complete. The company commenced construction on 2nd of January 2013. The following payments were made. Now, this is the payment. We now need to look at this note. We speak to this payment. Where did we get this payment from? The first payment of that first was funded from a company pool of debt. However, the company succeeded in raising a medium-term loan for an amount of 160 million, which is what? A specific source of finance. This 160 million is a specific source of finance. Why this 40 million is being withdrawn from a pool of funds that we don't know what comprises of that pool of funds yet. Let's take note. The first payment of that 1st January was funded from a company pool of debt. However, the company succeeded in raising a medium-term loan note for an amount of 160 million on 31st March 2013 at a simple interest rate of 9%, calculated and payable monthly in arrears. This fund was specifically used for the construction. Excess fund was temporarily invested at 6% monthly in arrears and payable in cash. The pool of debt were again used for a 40 million payment on 30 November. You see now, which means that only 2 withdrawals we made for our pool of funds. This and this. This first one here and this one.
Yes,
The rest we have here is from our specific fund. I don't know if you get the interpretation. And the construction project was temporarily halted for 3 weeks where substantial technical and administrative work was carried out. The following amount of debt were outstanding as at the reporting date. Here we now have what made up of our pool of funds. This is the specific fund. These 2 here are what make up the pool of funds. Now let's look at the solution. So did you understand all the parts here?
yes,
It's very clear. So you see that the first withdrawing is for pool of fund. This one is for pool of fund. We do our calculation of 9.5%, which is multiplying the 2 sources divided by the total amount. Hope everything is clear around this one.
yes, sir.
Okay. So you are now talking about the investment, right?
Yes,
Okay. Which part of the investment? This.
yes. I was thinking that maybe the 6% will be on the 160 million.
The 6% will be of the 150 million.
Yes.
Okay. I want us to look at this question together again. What makes you think that the 6% will be on the 150 million?
Because that was the amount given for raising a medium-term loan note.
So the 160 million, right?
Yes. And it was clearly stated that it was for the at a interest rate of 6%.
Okay. Now, did you also consider that this 160 million was made available to us at a particular date?
Yes.
Now, look at the date here. So the 160 million was made to us at our second drawing, which means that once we withdraw that second drawing, what we have left is not up to 160 million.
Okay.
Did you agree with me on that?
Yes.
We have 160 million as the known. Yes, I agree with you. But when was that 160 million made available to us? It was made available to us after our first drawing that we did from our pool of funds. Now, that second drawing that we did is from that 160 million. What is the amount of that second drawing?
90,000.
90,000.
90
90 million.
Yes.
If we remove, when we remove that 90 million, the rest has been invested.
Okay.
You get? Now,
Yes, sir.
when we want to do our third drawing, we want to do this third drawing now. In between this second and third drawing, this third drawing that we did here, don't let it confuse you. You get? Let's take it one by one. We have 160 million. Abi?
Yes,
So
sir.
that 160 million is given to us at this second drawing date. You get now that 160 million, we now withdraw 90 million from it. We kept the remaining portion in a short investment portfolio that is going to earn us 6%. Now, when we want to do our third drawing of 20 million, that 20 million has been kept in that short investment portfolio from this March till where we withdraw it. That is why we use 20 million multiplied by 6%.
Okay.
Now do the proportion of between what? When did we withdraw it? The money is made available to us in March. We now kept it in that short-term investment in April. We have it there in May. We have it there till June 30, which means that this 20 million that we are withdrawing now, let's assume this is today's date, 15th of September. So this 20 million we are withdrawing today now, we have kept it in that short-term investment from March till this June. That is why we have 3 divided by 12 multiplied by 6%.
Okay.
We want to do our fourth drawing again. Don't forget, this first drawing too is also part of what we have kept in the short-term investment from this date. So from the April, May, June, July, August, September, October ending. That is when we withdraw it again. So this 40 million has been in that short-term investment, earning us 6% return for that good 7 months. So the reason why we cannot use 160 million is because 160 million is not what we have in that investment as at this date. The money is made available to us on this date, and we take out 90 million from it. And even you say that, okay, 90 minus 60, 90 minus 160, that is what we should have in investment. That look very straightforward, which is the same thing here, 70. But that 70, we are not going to use 66% against a specific number of months because we did not withdraw it once. We keep withdrawing it in piecemeal. So as we are withdrawing one portion, the remaining portion we have there will continue to yield us interest. As we take out 90 million at first, we kept the remaining money so that portfolio to continue earning us 6%. When we withdraw 20 from the 70 we have 50 remaining. So this is the 50 year. When we go back again, we withdraw 40, we have 10 remaining. This is the 10 year. So that is the reason why we can't use 160.
Okay, sir.
I hope you understand.
Yes, sir.
Or do you have any question?
No, sir, I'm okay. Thank you, sir. I really appreciate it.
All right, no problem. Thank you very much. So
Hello,
you very
sir. Hello,
Okay.
sir. Is it possible
Yes,
to
I
share
wanted to ask if you would drop the
that
notes
short drawing?
For which one?
the other notes for the
I
IAS
will
38 and 37 that you started.
I will drop IAS 38. I will drop IAS 10. The reason why I will not drop IAS 37 is because we have not discussed it. But if you want me to drop it, no problem. But don't worry, I will drop IAS 38 and IAS 10 now.
Hello, sir. This IAS 23 that you just did now, for the sake of we that joined before you did it, after you did the class, can you just drop it for us, please? The calculation and the question.
All right, no problem. I will drop it. Okay. No problem.
Thank you.
Or you can visit the page on this YouTube link, so you will see the class there, so you can go through it. And if you have any question, when we meet again, we are going to look at it.
No problem. I will use the notes and go through it. Thank you, sir.
All right. Thank you very much, everyone, for the class. Thank you very much. Meet again during the week if we have free period, and if not, we'll meet again next week, inshallah. Have a good night rest with street drink. Thank you, everyone.
Thank you, sir.
Thank you, sir.
You're welcome.
Thank you, sir.
Have a good night, sir.